Have you been looking for opportunities to expand your dividend portfolio, but feel lost among so many companies? Do you find it impossible to keep up with the fast-paced world of investing, or are you a complete beginner? Then stay with me until the end of this video, because today I've brought you a very interesting company. Hi everyone! In this video, we're going to take a closer look at a company called Alexandria Real Estate. Alexandria Real Estate, founded in 1994, is a real estate investment trust focused on owning, developing, and operating life science and technology campuses in key innovation hubs across the United States. The company's properties are located in major markets such as Boston, San Francisco, San Diego, Seattle, and Research Triangle, catering to biotech, pharmaceutical, medical research, and technology companies. Alexandria generates revenue primarily through long-term leases with high-quality tenants, including Fortune 500 companies, academic institutions, and government agencies. The company currently pays $5.28 per year in dividends distributed quarterly. The next payment is scheduled for April 15th, and anyone who becomes a shareholder by March 27th will be eligible to receive it. The starting dividend yield is 5.46%, which is significantly above the 5-year average. The price per AFFO ratio is also well below the 5-year average, and the stock price is trading near its 52-week lows. Over the past year, the company has significantly underperformed the S&P 500. Based on these factors, the stock appears to be heavily undervalued. The most recent dividend increase was 5%, in line with the 5-year average of 5%. Over the past 20 years, the average growth rate was 4%, primarily due to a dividend cut during the 2008 financial crisis. Since then, the company has consistently paid and increased its dividend for 14 consecutive years. The payout ratio appears stable, and since 2021, there has been a slight downward trend, which is a positive sign. FFO and free cash flow per share show a modest upward trend, though the high interest rate environment in recent years has had an impact on performance. The company continuously issues new shares, which is completely normal for REITs, as it allows them to finance rapid growth. As long as the total sales graph follows a similar trend, there is no cause for concern. Debt levels are currently at healthy levels, but the company should focus more on this area in the coming years. However, a slight downward trend in debt has been noticeable in recent years, which is reassuring. Based on the current stock price, the starting dividend yield is 5.46%, which has been growing at a solid pace for 14 consecutive years. The credit rating is BBB+, which is considered strong, especially in this interest rate environment. Based on these factors, the company appears to be significantly undervalued. The 2024 annual report is overall positive, as the company demonstrated strong financial performance, achieved stable revenue growth, and successfully managed market challenges. The following key factors support this assessment. Positive factors: revenue growth. Annual revenue of $3.12 billion, an 8% increase compared to the previous year. Improved profitability. Net income rose to $510.7 million, a significant increase from $281 million in 2023. High occupancy and strong rental income, 94.6% occupancy rate, and a 16.9% lease renewal increase, ensuring stable income. Strong capital structure, $5.7 billion in liquidity, providing financial stability. Expansion of real estate portfolio, $1.51 billion invested in developments and acquisitions, indicating long-term growth potential. Negative factors: slight decline in operating cash flow, $1.5 billion, a minor decrease from $1.63 billion in 2023. Long-term debt management. Although the company manages debt well, the total debt-EBITDA ratio of 5.2x may limit future growth. Rising development costs. Inflation and increasing construction expenses in the real estate market could present long-term challenges. With strong revenue growth, high occupancy rates, and solid liquidity, the report is mostly positive. However, the company should closely monitor cash flow trends and debt management. AR is performing well in the current market environment and follows a sustainable long-term growth strategy. Project 2025 is a conservative political plan developed by the Heritage Foundation, along with several right-wing organizations, aimed at transforming the United States federal government under a potential future conservative administration. While Donald Trump previously distanced himself from the project, many of his political proposals and appointments align with the guidelines of Project 2025. Possible short-term impacts on Alexandria Real Estate Equities. Regulatory changes. Deregulatory measures planned under Project 2025, especially in the real estate and construction sectors, could reduce ARE's operating costs and accelerate its development projects in the short term. Tax policy changes. Potential tax cuts or more favorable tax laws affecting real estate investment trusts could enhance ARE's profitability and make the company more attractive to investors. Possible long-term impacts. Economic growth and the real estate market. If the economic stimulus measures proposed by Project 2025 are successful, the overall economic growth and increased demand for office and research facilities could positively impact the value and occupancy rates of ARE's portfolio. Environmental regulations. Potential loosening of environmental regulations could lower ARE's sustainability investment costs, but over the long term, there may be reputational risks if tenants and investors continue to prioritize eco-friendly properties. The political guidelines of Project 2025 could have a favorable impact on Alexandria Real Estate Equities, Inc. in the short term, particularly through improvements in the regulatory and tax environment. However, over the long term, changes in economic growth and environmental regulations may present both challenges and opportunities. It is important for ARE to closely monitor political developments and proactively adapt to changing circumstances. Alexandria Real Estate Equities has announced the issuance of a $550 million bond offering with a 5.50% interest rate, maturing in 2035. The bonds are being managed by several major financial institutions, and the sale is expected to close on February 13, 2025. The proceeds will primarily be used to repay the 3.45% bonds maturing in April 2025, as well as to pay down other debts, fund developments, and for general corporate purposes. AbbVie was formed in 2013 when healthcare giant Abbott Laboratories spun off its branded biopharma business. AbbVie has remained focused on branded drugs in immunology, oncology, neuroscience, and eye care. Its flagship product, Humira, treats autoimmune conditions like rheumatoid arthritis and Crohn's disease. AbbVie also offers Skyrizi and Rinvoq for immunological disorders, as well as cancer treatments such as Imbruvica and Venclexta. The company has underperformed the S&P 500 over the past 12 months. The company is currently available with a 3.57% starting dividend yield, which is lower than usual. The price per earnings ratio is 16.7 compared to the 5-year average of 10.8, making it equal to the sector average. Based on these factors, the company appears to be slightly overvalued. The company currently pays an annual dividend of $6.56 in quarterly installments. The next dividend payment will be on February 14th, and everyone who purchased the company's shares by January 15th is eligible to receive it. The most recent dividend increase was 5.8%, which exceeds my personal minimum requirement of 4%. The 5-year average was 9%, while the 20-year average was 14%. AbbVie was formed in 2013 when Abbott Labs spun off its branded biopharma business. The S&P 500 Dividend Aristocrats Index gives AbbVie credit for Abbott's long history of paying growing dividends, so the company has been continuously paying and increasing its dividends for 52 years. The earnings and free cash flow ratio may be slightly higher than ideal, but expectations suggest that the payout percentage will be reduced this year. Earnings and free cash flow per share have been declining for a few years, but this year might mark a turning point. The percentage figures might provide a clearer view of how revenues have changed. The company has not repurchased more of its own shares than it has issued since 2021. Return on equity has consistently been above the expected 25% since 2020, while the return on invested capital has shown a much more volatile pattern. The operating margin in 2024 was only 21%, instead of the expected minimum of 25%, but the free cash flow margin has been consistently above 20% over the past 10 years. The debt level seems quite high, but this is not surprising in the healthcare sector, especially in such an economic environment that characterized the 2020s or is still present today. The company offers a 3.57% starting dividend yield at the current price, with the most recent dividend increase being 5.8%. The credit rating is A-, which is considered good. Therefore, the company currently seems slightly overvalued, but it could still be considered a recommended investment due to its dividend, as there are no signs that the dividend payments are at serious risk. Disclaimer: this video does not constitute investment advice. Do not make decisions based solely on the content of this video. Always do your own research to determine whether a company aligns with your investment strategy and portfolio. AbbVie stock surged over 7% following its quarterly earnings report due to several key factors: earnings and revenue beat. In the fourth quarter, AbbVie reported adjusted earnings per share of $2.16, slightly surpassing analysts' expectations of $2.12. The company's net revenue reached $15.1 billion, exceeding the forecasted $14.8 billion. Strong performance of new immunology drugs. Despite a significant decline in Humira's revenue by nearly 50% due to increased biosimilar competition, AbbVie's newer immunology drugs, Skyrizi and Rinvoq, demonstrated substantial growth. Skyrizi's global sales increased by 58% and Rinvoq's by 46%, effectively offsetting Humira's decline. AbbVie provided an upbeat forecast, anticipating a 2025 adjusted earnings per share between $12.02 and $12.32, surpassing analysts' average estimate of $12.05. The company also raised its long-term sales outlook for Skyrizi and Rinvoq, now expecting combined sales of over $31 billion by 2027, up from the previous estimate of $27 billion. If Trump keeps his promises, several potential effects can be expected on large, global pharmaceutical companies like AbbVie. Regulatory and tax policy changes. During his previous term, Trump frequently emphasized the importance of deregulation and tax cuts, which could create a more favorable business environment in the short term. This could improve companies' financial performance, as less bureaucracy and lower taxes would allow for more investment in research and development. Drug prices and healthcare policy. At the same time, some of Trump's promises may include measures to reduce drug prices, which could put direct pressure on the revenues of large pharmaceutical companies. If stricter pricing regulations are implemented, it could lower AbbVie's profits, particularly for products that generate significant revenue from high prices. Trade and foreign policy measures. Trump's foreign policy and trade policies, such as protectionist measures and new trade agreements, could affect exports and imports. Some measures could be advantageous for U.S. companies in the short term, but over the long term, changes in global markets could create uncertainty. Overall, if Trump keeps his promises, AbbVie and similar companies would face mixed effects. On one hand, a more favorable business environment and lower taxes could be beneficial, while on the other hand, measures to reduce drug prices could put pressure on profits. The outcome will depend on how extensively and in what way the political measures are implemented, as well as how the company adapts to the new regulatory environment. Realty Income got its start in 1969 with a single investment in a Taco Bell. Today, the retail REIT owns thousands of properties across America, leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of the firm's rental revenue, with industrial warehouses and gaming venues generating almost all of the remainder. All properties are under long-term triple net lease agreements, which shift property operating expenses to tenants and generate predictable cash flow to fund monthly dividend payments. The company currently pays an annual dividend of $3.07, distributed on a monthly basis. The next payment will be on February 14th, and anyone who becomes a shareholder by February 3rd will be eligible to receive it. At the current stock price, the starting dividend yield is 5.89% compared to the 5-year average of 4.72%. The forward price per AFO ratio is 12.5, whereas the 5-year average was 16.5, and the sector average is currently 16.2. Over the past 12 months, the company has significantly underperformed compared to the S&P 500. Based on this, it appears to be undervalued at the moment. The most recent dividend increase was 3%, which is below my minimum expectation of 4%. However, from a company offering such a high starting dividend, significant growth is not to be expected. The 5-year average increase was also 3%, while the 20-year average was 5%. The AFO payout ratio has been on a declining trend and stood at 75% over the past 12 months, which seems very healthy. AFO per share has been steadily increasing year over year and at a faster rate than the dividend. As a result, dividend increases may accelerate again in the future, or if the company faces a few weaker years, the dividend will still remain secure. The shares outstanding chart shows a strong upward trend, which is entirely normal for a company like Realty Income. This is one of the ways they finance their growth. REITs receive tax benefits but are required to distribute a large percentage of their profits as dividends to shareholders. This limits their ability to grow quickly through retained earnings, so they rely on issuing shares and taking on debt. Debt levels are also at a completely healthy level, and a declining trend is visible here as well, which is reassuring. The company is currently available with a starting dividend yield of 5.89%, which has been increased by 3% in recent years. Its credit rating is A-, which is considered good, meaning the dividend is not at risk. Additionally, the stock appears to be undervalued. Key financial points: investments and returns. During the quarter, $740 million was invested, including $378 million in the US, with an initial yield of 7.4%, and $362 million in Europe, with an initial yield of 7.3%. AFO, growth and profitability. AFO per share was 1.55, representing a 2.9% growth compared to the previous year. Portfolio performance and stability. The real estate portfolio occupancy rate stood at 98.7% at the end of the quarter. Rent recapture across 170 renewed leases was 105%. Financial flexibility and capital position. The company had $5.2 billion in available liquidity at the end of the quarter. Debt levels remain manageable through 2025. Overall evaluation. The report is mostly positive because it shows stable revenue and AFO growth. High portfolio occupancy and positive rent recapture rates were reported. The company maintains significant liquidity and a manageable debt level. Future guidance indicates further growth. Although economic uncertainties remain, the company's financial position and strategic direction suggest strong and sustainable growth prospects. Project 2025 is an initiative spearheaded by the Heritage Foundation, a conservative think tank aiming to reshape the U.S. federal government under a potential future Republican administration. The project outlines comprehensive plans to centralize executive power, reduce regulatory oversight, and implement conservative policies across various sectors. Potential impacts on the company: short-term effects, regulatory changes. The project proposes dismantling or significantly reducing the authority of federal agencies such as the Environmental Protection Agency and the Federal Trade Commission. This could lead to immediate changes in compliance requirements, potentially reducing operational constraints for companies in industries like energy, manufacturing, and technology. Tax reforms. Project 2025 advocates for overhauling the tax system, including reducing corporate tax rates and shifting towards a consumption-based tax model. In the short term, this could result in decreased tax liabilities and increased after-tax profits for corporations. Long-term effects. Market dynamics. The proposed deregulation and reduction of federal oversight might foster a more business-friendly environment, potentially spurring innovation and competition. However, the lack of regulatory safeguards could lead to market volatility and increased risks, particularly in sectors like finance and technology. Social and environmental considerations. The project's stance on environmental deregulation and social policies may lead to public backlash or shifts in consumer preferences. Companies may face pressure from stakeholders to uphold higher environmental and social governance (ESG) standards, potentially leading to reputational risks if they are perceived as aligning with regressive policies. In summary, while Project 2025 aims to create a more streamlined and business-friendly regulatory environment, companies must carefully assess both the opportunities and risks associated with these proposed changes. Strategic planning and stakeholder engagement will be crucial to navigate the evolving landscape effectively. Disclaimer: this video does not constitute investment advice. Do not make decisions based solely on the content of this video. Always do your own research to determine whether a company aligns with your investment strategy and portfolio. Thank you for joining us today on the Financial Freedom Channel. If you enjoyed the video, don't forget to like it and subscribe so you can stay up to date with the latest financial tips and analyses. If you have any questions or would like to share something, feel free to leave a comment. Remember, we're building financial freedom together. Stay with us and we'll see you in the next video.